Okay, guys, so if you are looking at individual performances of stocks, they might bring you a certain return back of how much they make you in profit every year. So, what I wanted to do on this video is actually go over these four and just Google, for example, the type of returns that you can get. So, for example, REITs, I just Google REIT yearly profits, and you can see here return of REITs. It says RE, REIT index, the 5 year return of US REITs was about 15.76% in June 2020. And it says that the typical stock that is non REIT is basically about 10%. So they're saying that REITs typically return about a 15% profit. So that's the first one, right? And what are REITs? Which what they actually stand for is actually real estate investment trust. So that's actually what it stands for. Long story short, basically what it is that you invest in a particular stock, and managers of these portfolios will actually use the money that investors put into that stock, and they will invest in nothing but real estate related projects or properties with the intention of growing the money, right? And to provide a return of about 15% yearly on average. So that's basically what it is. Mutual funds. Mutual funds are investment strategies that allow you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities so that might be difficult to recreate on your own. What does that mean? Let me show you a quick image here of what that means. So here's the investor, the fund manager, securities, the returns. You see that? So this would be us. We put it into a stock, a mutual fund stock. A manager will, manage the money. They decide where to put it, and then we get a return. So that's the long story behind it. If you search mutual funds yearly returns, or you could say returns, yearly returns, just like that. Just to kind of give yourself an idea. And you can see here, you can have a better idea of what kind of returns you get on here. So you can see the 5 years. So you basically have an idea, right? It just depends on which ones you select. But they're saying that 5 years is about 22%. So that's basically the whole idea. And you'll see that these are talking about like short-term periods of how long you held on to the stock. So over a period of time, over 5 years, it typically goes from 15 to 20% yearly. Now, ETFs, what are ETFs? They're an exchange traded fund. It's a type of security that tracks an index sector or commodity or other assets, which can be used to purchase or sold on a stock exchange, the same as a regular stock. So, long story short, it's just a portfolio of where uh, many types of companies are being purchased into one portfolio. And it's not so much on focusing on real estate, for example. It's more diversified as far as the type of companies that are placed behind those portfolios. So let's go ahead and search ETFs yearly returns. So you can see that it really varies. It depends on which ETFs you select. So, for example, they're saying that a typical ETF could be about 10%, right? So it really depends on the one that you select. And the last one are index funds, which, can vary 10% as well. What are they? They're just multiple stocks, one portfolio.